Welcome back, investors. Thanks for joining in. Today we'll be looking at Evolution AB, a company with phenomenal performance since its IPO in 2015. For those who don't know, Evolution is the world's largest provider of online casino games. They facilitate games for online casinos like blackjack, roulette, and many of their own game shows. Since this company is from Sweden, it was only available on the Stockholm Stock Exchange, but since 2016, it also has an over-the-counter listing on the US. And if you had invested when this listing happened, you would have seen your investment go up almost 20-fold. This company is also held by popular investor Chris Mayer, who wrote the book 100 Baggers. By the way, this is a book I highly recommend checking out. It's great for investors focusing on growth. Evolution also makes up a decent chunk of my personal portfolio. Currently, it's my second largest holding, sitting at an allocation of 13%. To get a understanding as of why this company has risen so much in value, we will head over to our Stock Insight tool to get an overview of the fundamentals of this company. If we just briefly look at the metrics presented here, we can already see why this company has a reputation of incredible performance. Every single revenue, earnings, and free cash flow metric is growing at a rapid pace, with growth rates exceeding 30 to 40% annually. Cash has been in a solid uptrend as well, making them currently sit at a cash pile that is significantly larger than their debt position. Shares outstanding is very stable as well, with dilution in 2021 for an acquisition of multiple slot machine game studios. They have recently started with a small share repurchase program, which is a great sign for the future. We can also see the profit margins keep rising every single year. And keep in mind, this is a margin of net income, so for every dollar that Evolution earns, they keep around 60%. Even companies like Visa have lower margins. We also have incredible ROIC and ROE, but these are metrics we'll be looking at more closely in the next segment of today's video. Here we'll be zooming into some ratios and metrics to see if Evolution fits our preferences when valuing a stock. We'll be performing our valuation in 3 steps. First is the margin of safety. In this segment, we'll be assessing Evolution's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. In the second step, we'll be performing various valuation models to see what the intrinsic value is of the company based on different metrics. And lastly, we'll combine the 2 steps to give us a fair value of the company. To determine our final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the growth, and the health of the business. We'll be using a standard margin of safety of 30%, and this margin of safety cannot go below 0%. To determine how much we should increase or decrease our margin of safety, we use a scale. And when we're using 4 colors, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. The first metrics that we'll be looking at revolve around growth. Here we'll be looking at the earnings per share growth and the free cash flow per share growth. As we saw earlier, Evolution's performance on this area is nothing short of stunning. Earnings per share has gone from 7 cents a share in 2015 to 3.31 euros in 2023. When determining our growth rate, we'll be only using the past 5 years, and here the growth average is 62%, giving us a margin of safety deduction of 10%. Besides this, we also have the free cash flow per share growth, which has risen from 7 cents to 5.03 euros a share in 2023. In the past 5 years, this is a growth rate of almost 71%, which is once again in the bright green part of our scale, indicating a 10% deduction in a margin of safety. Next up, we have the financial health, where we'll be looking at the debt to EBITDA ratio and the Altman Z-score. Debt to EBITDA is calculated by taking the debt of the company and subtracting the cash from it, and then dividing it by the EBITDA, giving us the amount of years of EBITDA needed to repay all debt. Since Evolution has a very small debt position of only around 80 million euros and a cash pile of over 500 million euros, investors do not have to worry about debt. This awards them with another 5% deduction in a margin of safety. The Altman Z-score is a ratio used to predict whether a company is likely to go bankrupt or not. It is formed by using a bunch of different metrics like working capital, total assets, market cap, and sales. When a company scores lower than 1.8, it has a high chance of going bankrupt, while a score of over 3 means that it's very safe. Due to the strength in Evolution's financials, the score here is the highest I've personally ever seen, sitting at 15.1. Comparing that to another high-growth compounding stock like Visa, which has a score of 8, we once again see the quality of this company. The next segment is focused on us, the shareholders. What is the company doing to reward us if we hold the stock? Over the years, Evolution has focused on retaining a 50% payout ratio at all time. This means that when margins increase and therefore net income, investors will be rewarded with higher dividend hikes. Dividends have gone from 6 cents a share to the recently announced 2024 dividend of €2.65. This is a growth rate of 63% on average, which is another 10% deduction in a margin of safety. In terms of share buybacks or dilution, we already spoke earlier about the acquisitions that Evolution has done in 2021, where shareholders were diluted. This brings our total dilution in the past 9 years at 20%, which adds 5% to a margin of safety. And lastly, we have the capital allocation metrics, where we will be checking out the return on equity and the return on invested capital. This first ratio is calculated by taking the net profit and dividing it by the equity. It is sitting at 27%, which indicates a solid performance on this area, and another 5% reduction in a margin of safety. Besides this, we have the return on invested capital, which is calculated by taking the EBIT, tax rate, and the invested capital. This ratio gives us an idea how effective the management is at allocating capital. Evolution is a capital-light business, meaning that they can maintain a lower reinvestment rate. The investments that they have been doing, however, have been of great quality. The current ROIC stands at 31%, which is in the bright green part of our scale. As we can see, this company ticks the boxes on almost every metric that we grade. This quality gives us a 0% margin of safety that we'll be using at the end of our valuation. And let's go look at the valuation models next to determine the intrinsic value of Evolution. The first valuation model that we'll be using is the discounted cash flow model. And here we can see that over the years, the average free cash flow growth for Evolution has been sitting at 89%. And this model will be making up 3 cases: a normal case, a best case scenario, and a worst case scenario, where in the normal case, we have a 17% short-term free cash flow growth and a 12% long-term growth, and we'll be using a 9% weighted average cost of capital and a 3% perpetual growth rate, and this is the same in all of the other cases. In our best case scenario, we have a 22% short-term growth and a 17% long-term growth, and in the worst case, we have a 12% short-term growth and an 8% long-term growth. This leaves us with a sum of all of the free cash flows of almost 26 billion euros. To get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of over 26 billion euros. Dividing this by the amount of shares outstanding, we get an intrinsic value of 125 euros. With a current price of 122 euros, we get an upside of only 3% out of this model. The second model that we'll be using is the discounted dividend model. Here we'll be looking at the annual dividend growth in the past and be projecting it in the future. The average growth rate in their dividends over the years has been sitting at almost 63%. And for a short-term growth rate, I projected a 15% dividend growth. And for a long-term growth rate, we have a 7% growth. And we'll be using, once again, a weighted average cost of capital of 9% in this valuation. And this gives us a sum of all of the dividends in the future of 207 euros. And with the current price of 122 euros, this gives us an upside of over 70%. And the last model that we'll be using is the mean reversion theory. In the mean reversion theory, we go by the theory that a company will always trade above or below its mean. And the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average for Evolution, it has been sitting at 1.30%, while the current yield is sitting at 2.20%, indicating that's undervalued on this metric. Doing the same with the PE ratio, on average it has been sitting at 41.20, while the current PE ratio is sitting at 24.14, indicating that's once again undervalued on this metric as well. This gives us a mean deviation of 41%. Giving us an intrinsic value of 172 euros. And with the current price of 122 euros, this gives us the same upside as the mean deviation. Now that we've gone through all of our models, let's go look at the final overview of our valuation. Coming to our final overview, we've imported discounted cash flow, discounted dividend, and the mean reversion theory price per share, giving us an average of 168 euros. Our margin of safety we've determined earlier, using a standard margin of safety of 30%, deducting it by 10% for the earnings per share growth, free cash per share growth, and the dividend growth, and deducting it by 5% for the debt to EBITDA, Altman Z-score, return on equity, and return on invested capital, and adding 5% for the share dilution, giving us 0% margin of safety. Keep in mind though that these metrics are all based on my preferences as an investor, and this might change for you. So I'll be using this 0% margin of safety in this. And this gives us an intrinsic value of 168 euros. And with the current price of 122 euros, this gives us an upside of 38%, indicating that it's undervalued. Let's say if you wanted to use your own margin of safety, because you have other preferences as an investor, we would still get an upside of 15%, meaning that the stock is severely undervalued in my opinion. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And if you want to get access to all of our tools, like our Stock Insight tool and all of our valuation models, you can check in the description for our Patreon link. Thanks for watching and see you next time.